Well, it's time for us to look at financials for the future. What does that mean? Let me make you aware of and introduce you to management accounting, or as it might be called, managerial accounting. And I think that that becomes a very big part of an art that has in many years fallen away. But what I want to talk about is, what is it? What does it do? Management accounting is the practice of identifying, measuring, analyzing and interpreting, and communicating financial information to managers in their pursuit of the organizational goals. It's a little different from financial accounting because its intended purpose is to assist executives in the company in making proper and well-informed decisions based on current performance analytics. And again, I want to stress the fact that it is an internal look. It's looking at the internal controls. What is to be done based on how the company is performing. And so it encompasses many facets of accounting, but it includes product costing, a big part of it in today's world. Budgeting, that we've had a previous session on, in identifying how important that is in terms of defining the goals and the pathway to the success for your strategic plan. It deals with forecasting. Forecasting, a very big part of life today, and becomes ever increasingly important in helping to determine where you've been over the last 3 months and where you expect to go, despite the fact that you have an accurate budget. This is your update. And then also various financial analysis that includes the productivity type of analysis and a look at your business internally. So when we look at the flow of what happens in the management accounting cycle, literally we could say it starts with budgets which feed into planning. And on the left-hand side, the planning and the plan and the strategic plan in your financial activity gets an action plan, and how is it implemented, and then there's an evaluation and feedback. But what influences that? On the right-hand side, we have source documents, invoicing, etc., that go and get posted to the ledgers and the sub-ledgers. We develop performance report, which all feeds into the evaluation feedback, and ultimately that then gets back to changing some of the planning that you have in terms of being able to attain and reach your goals. So what are some of the concepts around management accounting? And I want to take some time to just explain this next coming session, because marginal costing is probably the one part of the business that is becoming more and more prevalent. It's the cost volume profit analysis, in other words, which is really the impact of the cost of a product by adding additional units of production, and for its useful short-term economic decisions. So when we look at the considerations, the contribution margin of a specific product is its impact on the overall profit of the company. Margin analysis flows into break-even analysis, which involves calculating the contribution margin on the sales mix to determine the unit volume at which the business gross sales equal total expenses. We're going to get into the description of this a little bit more, but I do want to highlight these important points. And identifying the break-even point analysis is useful for determining the volume and in both the volume points in sales and also in dollar value that you need to develop for products and services so that the company can cover its expenses and move forward. Let's have a look at what that basically boils down to. We talked about a contribution margin. What is that? As we can see on this graph, we have variable costs. Variable costs are going to be things like labor that's directly attributable to making the product, the materials, and the production capacity that's used to develop and make the product or convert it from one item to another, raw materials to an end-used product. And then we have a selling price. So if we look at the sales price The difference between the sales price and the variable cost of a unit of production, that is your contribution margin. And what do I mean by contribution margin? The contribution margin is going to be, as I said, your sales minus your variable cost, and it is to be used in determining your break-even point in sales. And so what this basically tells me is what it is that I need to have in sales volume to be able to cover all of my expenses and make sure that I have a business model that is now addressing all the costs, and I know where and at what level I will be at par for the course and I'm not underwater or not making a loss. So contribution margin basically means a contribution to my fixed costs and profitability. What does that ultimately boil down to? If I'm looking at my fixed costs and my profit, it's a number that I'd like to achieve. So if I've taken my sales and I've taken out my variable cost, that contribution margin, which many people call a gross profit, that's a contribution margin to my fixed cost. So how much do I have to sell and get that margin to cover all of my fixed costs and or profitability? So if I divide the total fixed cost by the contribution margin, I will determine the break-even point of in sales in terms of total dollars as well as my volume. Let us have a look at what we've just spoken about. If we have a look on the right-hand side of this graph, we'll see that there's a bracketed amount that highlights your fixed cost. That number is not going to change. It's going to be there for as long as the business is in place. And it would include things like rent that you've paid for, and it doesn't matter what level of production you have, that's going to be your fixed cost. Above that, we have variable costs, and you can see that that variable cost line goes from left to right. It starts a little bit above that red portion of the loss. I'm mentioning this because it's the level at which your fixed costs are, and the variable costs just increase with the number of units sold. It's directly proportional to the number of units sold. Now, let's have a look at that bottom orange line that goes from the bottom left-hand corner to the top right-hand side. At the point at which your revenue meets up with your level of costs, which includes now your fixed costs and your variable costs, you see where it's got that little arrow that says break-even point? That's the number of units. If you drop a line straight down, that'll give you the number of units that need to be sold to determine your break-even point. So a great measure would be to understand how many units do you have to sell, produce and sell in any given period, daily, weekly, monthly, quarterly, annually, and then also what level of revenue does that represent to cover your costs. On the right-hand side of that scale, it'll identify the profit, and from that break-even point onwards, the number of units will now make, and the extra number of units sold will give you the level of profitability that you're looking at. Let's just have a look at what this might mean in terms of numbers and how do we calculate this. So top line, I have a sales number. I might be at a number like $90 million, and I've got a total number of units that I've sold to date which amount to 224,000 units. So my average sales price per unit would amount to 404, as we can see. And my variable cost that I will pull out will be 20,000 of my expenses that relate to materials and labor, etc., divided by the same number of units, tell me that I have a variable cost of $92 per unit. So when I deduct one from the other, the 404 minus the 92 leaves me with a contribution margin of $312 per unit. Now, when I have a look at my fixed cost at 4.3 million gives me a break-even number in units of about 14,000. In other words, I take the 4.3 million divided by the $312, and I end up with 14,000 units that I would need to sell. And if I look at my average selling price, my break-even number would be my 14,000 times 404, which would give me my 5.6 million. So at 5.6 million, 5.681, 282 million, I have now covered, I've done enough sales to cover both my variable cost and my fixed cost, and I'm at zero, I'm at break even. That's a pretty important part of the business to understand. So in managerial accounting, there is a very strong emphasis as well on cash flow analysis. And it's important to perform this cash flow analysis in order to determine the impact, the cash impact of the business decisions, and by implementing working capital management strategies to optimize your cash flow. And this is to ensure that the company has enough liquid assets to cover short-term obligations. Here's a big thing. We spoke in the earlier chapters about things like how much inventory you have. How much does that mean in terms of money that's coming in, but also to calculate when it comes in, because you have salaries and wages to pay, so you've got your labor costs, and you have materials that you have purchased to be able to convert. Those have to be covered. It's a very, very important part to understand that cash flow, because even though you may be getting to the point of getting bigger projects, bigger numbers, that could have a massive impact on your cash flow analysis, because there's a very clear difference between profitability and cash flow, and it is important to understand how those could work out. A practical example, a company does on average $20,000 in sales per sales contract, and they can cover that with, they can cover the cost of sales on a monthly basis if they do, let's say, 200,000 a month. That's easily done perhaps with the cash flow that they have. But if that company was now to go into signing contracts for several $1 million or $1 million, the cost of sales and the materials and the labor cost to get that produced has now gone up substantially. And if you're now looking at the time it takes to get cash in through your AR, that could be a big problem in terms of managing your cash and making sure that you have enough working capital. So it gets to the point where, from the management accounting side, it's very important to then also look at turnover analysis. These are some of the things that are pretty pertinent to a business today, to kind of not only stay alive, but to become a lot more vibrant and become successful and exist through these periods of time where money now becomes a very, very tough thing to manage. Inventory is a big part of the calculation, because we want to look to see how many times has a company turned over the inventory. What is the purpose behind that? Because we don't want to have too much inventory at any one point in time. We want to be able to establish what would be good for us to be able to have as inventory and stock levels and safety stock. What is the good purchase order quantities? What is the economic order quantities? What are the lead times? And that's going to help us to define and make decisions on pricing, manufacturing, marketing, and the purchasing of new inventory. Because what we don't want to do is have too much inventory that our carrying costs will be too high, but we also don't want to jeopardize the potential production for an increased number of sales by having a shortfall. Big part of this is cash is king, as we said, and therefore we need to keep the cash flow free for the potential to be able to manage and drive other parts of the business. So what are some of the constraints, and what are the constraint analysis? Basically, what we want to make sure we do within that function of management accounting, which is now very much part of the portfolio within the CFO's role, the new CFO's role, is to review the constraints within the production and or the sales process to determine if there and where there are bottlenecks that may occur, and calculate the impact of these constraints on revenue, profit, and cash flow. Very quick example. In a competitive market where you may have a competitor or a number of competitors that come into the market space and have dropped the price, it might behoove you to look at which of the product lines are causing you more bottlenecks within the company through the production process, and are the prices that you have and are charging for those products worthwhile, and are those products worthwhile keeping? So you've got to look to do that profit analysis on each product and the contribution analysis, because it could very well be that which you believe is a bigger, better, more expensive product or better sales number might very well be the thing that costs you the most and actually puts an impact and a constraint on your profitability and hence your cash flow. A very big part of this is for managers to also look at this information and implement changes in efficiencies in production. Speaking about it when we do things like budgeting, we want to understand that these numbers are accurate because, again, from a production number perspective, we may not, whilst we be there for 8 hours in a day or in a shift, we may not be working the full 8 hours. We could only be working maybe 6 hours because of downtime, lunch times, and tea times. And then within that 6 hours, how efficient are we so that we could establish for ourselves a level of efficiency against which we will then determine the cost, which helps to drive the pricing and makes us aware of the fact that we either have made a profit or that we can make a profit at that level and not have this as a loss leader. We also need to make sure that we manage from the accounting side the financial metrics that need to be looked at. And so it's important, especially as companies come out of these recessionary times, as you look to build and grow, there will be opportunities now for mergers, for acquisitions. And so it's going to be important to understand how well you could leverage your cash and your money, and what does that mean for you in terms of being able to manage borrowed capital, pay back your loan, service that debt. So balance sheet analysis helps with this analysis to provide you with the tools. It's a very big part of it. It always has been a big part of it, but it now becomes very critical for people to measure and perform to the better standards of these metrics so that the company can survive. And then we have performance measures such as return on equity, debt to equity, and return on investment capital to help management identify the key information about borrowed capital. It's important for management to review these ratios and statistics regularly and be able to appropriately answer questions from its board of directors and investment. I would like to emphasize that is something that, in my opinion, becomes a lot more of a important factor for people to understand how their businesses work, and the management accounting information which is derived through understanding what's going on in your business is critical to be able to provide the facts that will help to achieve the end result with investors and creditors. Let me talk a little bit about accounts receivable management, which many people consider a standard performer for any financial function, especially CFOs, controllers, VPs of finance. But in this particular slide, let me mention one big thing, that even though it's important because it's going to help to define your cash flow, your bottom line number that comes in on a monthly basis, and the review of whether or not customers are valuable or they credit risks, are you going to have bad debt out of them? One of the most important things that I had personally seen as a takeaway is that there are instances where a customer can tell you a little bit more about your business through its accounts receivable performance than you might know through your other performance analysis. And that might be that customers are taking huge discounts, and that could be a reflection on either the status of the customer, which we know, or more importantly, the quality of the products and or services provided. Are you doing the right thing? Are you meeting with your service agreements that you may have in place? Are the quality of the products what is expected? Is the delivery time done to the big box companies on time? Are the products delivered without damage? Is it of a good quality? Various of these analyses will help you to understand, but some of it could come very simply from an accounts receivable review, and that's what I talk about, making a deeper and more in-depth analysis of receivables. Very importantly would be the next part of this process, which is covered in the budgeting sector, but that is budgeting, trend analysis, and forecasting. And budgets are extensively used as a quantitative expression of the company's plan of operation. We need to make sure that all of these budgets are done well, that they are covered in enough detail, because we do not want to see that when we do variances and have these deviations from actuals, of actuals to budgets, that those numbers start to become meaningless. They absolutely need to have a valuable bit of input so that the company and its management can take the appropriate actions based on the analysis and provide the changes to go forward to improve, increase, change, and make more efficient the company, and obviously therefore impacting the profitability. The analysis and relayed information related to capital expenditure decision is also very important and includes the use of standard capital budgeting metrics. You know, one of the things that we could be very much caught up in is the ability to get new, greater pieces of equipment and capital items, but not identifying what the return would be based on the expense that has been laid out. Very critical, because at the time when cash is king, this is a very, very important part of the business. So, in summary, it is critical within this function to review the trend line for certain income and expenses and investigate the unusual variances and deviations, and include the use of historical pricing. It helps to set the trends and identify what's going on, sales volume, geographical locations, customer tendencies for financial information. And this field of accounting also utilizes previous period information to calculate and project future information.